Welcome to the Wealthfinity channel. In this video, we're going to be discussing the top strategies for building wealth and achieving financial freedom. Whether you're just starting out on your financial journey or you're looking to take your wealth to the next level, you won't want to miss the valuable insights and tips that we'll be sharing. So sit back, relax, and get ready to learn how to unlock your full financial potential with Wealthfinity. Thanks for watching. The current ratio is a financial metric used in accounting to measure a company's ability to pay its short-term obligations. It is calculated by dividing a company's current assets by its current liabilities. The current ratio is an important measure of a company's liquidity and solvency, and it is used by investors, lenders, and analysts to assess a company's financial health. Current assets are assets that are expected to be converted into cash or used up within a year. Examples of current assets include cash, accounts receivable, inventory, and short-term investments. Current liabilities are obligations that are expected to be paid within a year. Examples of current liabilities include accounts payable, short-term loans, and taxes payable. To calculate the current ratio, divide a company's current assets by its current liabilities. The resulting number is the current ratio. A ratio of 1 indicates that a company has exactly enough current assets to pay off its current liabilities, while a ratio greater than 1 indicates that it has more than enough current assets to do so. A ratio less than 1, on the other hand, indicates that a company does not have enough current assets to pay off its current liabilities and may be at risk of defaulting on its obligations. In addition to the current ratio, there are other measures of liquidity that are used in accounting, such as the quick ratio and the cash ratio. The quick ratio is similar to the current ratio, but it excludes inventory from current assets and is considered to be a more conservative measure of liquidity. The cash ratio is the most conservative measure of liquidity, and it is calculated by dividing a company's cash and cash equivalents by its current liabilities. It's important to note that the current ratio is only one of many financial metrics that investors and analysts use to evaluate a company's financial health. Other metrics, such as the quick ratio, the acid test ratio, and the cash ratio, provide a more detailed look at a company's liquidity and solvency. However, the current ratio is a widely used and easily understood metric that can provide a quick snapshot of a company's short-term financial health. A high current ratio is generally considered to be a positive sign, while a low current ratio can indicate financial trouble. One important thing to keep in mind is that the current ratio is only one of many financial metrics used to evaluate a company's financial health. Other important ratios include the debt-to-equity ratio, the quick ratio, and the return on equity. Additionally, it's important to look at a company's cash flow and overall financial performance over time, rather than just relying on one ratio. Understanding and interpreting the current ratio is an important aspect of financial analysis. It helps investors, creditors, and management of the company to assess the short-term financial health of the company. A healthy current ratio is usually seen as a positive sign, indicating that a company has the resources to meet its short-term obligations. However, it's important to also evaluate other financial metrics, as well as the company's overall financial health and business prospects, in order to make a well-informed investment decision. A high current ratio indicates that a company has a large amount of assets that can be quickly converted to cash, while a low ratio suggests that the company may have difficulty meeting its short-term obligations. There are several benefits to knowing what the current ratio is and how to calculate it. First and foremost, it gives investors and analysts an idea of a company's financial health. A high current ratio indicates that a company has a healthy balance sheet and is less likely to default on its debts. On the other hand, a low current ratio may signal that a company is in financial trouble and is at risk of defaulting on its debts. In addition to providing insight into a company's financial health, the current ratio can also be used to compare different companies in the same industry. For example, if one company has a current ratio of 2 and another has a ratio of 1, it is clear that the first company is in better financial shape than the second. This can be useful for investors looking to invest in a specific industry, as it allows them to compare the financial strength of different companies and make informed decisions. Another benefit of knowing the current ratio is that it can be used to identify trends in a company's financial health. For example, if a company's current ratio has been steadily decreasing over time, it may be a sign that the company is experiencing financial difficulties. On the other hand, if the ratio has been increasing, it may be a sign that the company is in a strong financial position. The current ratio is an important measure of a company's liquidity and solvency, and it is used by investors, lenders, and analysts to assess a company's financial health. A high current ratio indicates a strong ability to meet short-term obligations, while a low current ratio may indicate financial distress. However, it is important to keep in mind that the current ratio is only one measure of a company's financial health and should be considered in conjunction with other financial metrics and analysis. In conclusion, the current ratio is a key financial metric that helps assess a company's short-term liquidity and ability to pay off its debts as they come due. It is calculated by dividing a company's current assets by its current liabilities. A ratio of 1 or higher indicates that a company has enough assets to cover its liabilities, while a ratio below the first of may indicate that the company may struggle to meet its short-term obligations. It's important to note that the current ratio alone does not give the full picture of a company's financial health, and should be considered alongside other financial metrics such as the quick ratio and cash flow analysis for a more complete understanding. Overall, understanding and utilizing the current ratio can provide valuable insight into a company's financial stability and help inform important business decisions.